All right, let's dive right in. Today, February 20th, 2026, the global markets just went on an absolute tear, a powerful surge that really took a lot of people by surprise. So, what on earth was behind this sudden wave of optimism? Well, we're going to break down the anatomy of this massive relief rally, piece by piece. Let's get into it. Take a look at this number, 25,012. That's where the Nasdaq 100 closed today. Now, for weeks, that 25,000 mark has been this huge psychological wall, a barrier the market just couldn't seem to climb over since that downturn earlier this month. But today, it didn't just tap the wall, it blew right through it. And the reason why is a complete game changer. So, what was the catalyst? A landmark decision from the U.S. Supreme Court that basically nullified those sweeping tariffs from back in 2025. This single legal move just ended what analysts have been calling regime uncertainty. Think of it like a year-long fog that's been hanging over everything, making it impossible to see the road ahead, suppressing investment, and tangling up supply chains. Today, that fog just lifted, and the markets reacted instantly. So let's look at the immediate aftermath, because it was pretty incredible. The response across the US and Europe was this broad, powerful relief rally. It was like a year's worth of pent-up optimism was finally unleashed all at once.
The reaction was immediate. We saw really strong gains here in the US. The Nasdaq was up almost 0.9%, the S&P gained nearly 0.7%. But what's really fascinating is that the momentum in Europe was even stronger. France's CAC 40 just soared, up 1.39%, and the U.S.Stock's 50 climbed over 1.1%. So this wasn't just a U.S. story. It was like the entire global market took a synchronized deep breath out. But why? Why was the reaction so incredibly powerful? Well, to really get it, we can look at this surge through 5 totally different theoretical lenses. Each one gives us a different layer of understanding of what was going on in the market's mind today. Okay, first up, from Gunter Dueck's point of view, the market was basically stuck in a fear regime. The tariff threat made every investor play defense, hoarding assets. But today's court ruling, it acted as a reason trigger, a logical, undeniable event that let the market's collective brain say, okay, the danger is gone, which sparked this super rational and really rapid repricing of all those high-growth tech stocks. Second, we've got the Austrian school framework, through Seyfedin Emus. They see this as a restoration of market integrity. See, tariffs are like static on the radio. They distort price signals and make it almost impossible for businesses to plan ahead. By ripping them out, the court basically let companies make long-term plans again. And you can see this perfectly in the Philadelphia Semiconductor Index, which jumped over 1% today. Why? Because now chipmakers can plan their big capital spending with way more certainty. Now, Ken Fisher's framework suggests the market is a great humbling machine that's always looking past the fears everyone is talking about. So, in his view, the whole tariff drama of 2025 was old news. It was already fully priced in. So, today's rally wasn't about learning something new. It was about the resolution of that old fear, which allowed the market to just kind of shrug and waltz right past it and keep moving higher. John Cassidy's work offers another fascinating take, that social mood drives events, not the other way around. Think about it. The underlying mood in 2026, fueled by this AI revolution, has been really positive. The court ruling didn't create the optimism. It was just the catalyst that cleared the path for this positive mood that was already there to really express itself and push the market higher. The S&P 500 basically acted as a social mood indicator today. And finally, from a cyclical perspective, Edward R. Dewey's research points to this recurring 41-month cycle in U.S. stocks. According to that model, we're in the late expansion phase. The tariffs were acting like friction, kind of like hitting the brakes and slowing down the cycle's natural rhythm. By removing that friction, you just let the market accelerate toward its mathematically predicted peak in the middle of this year. Now, let's shift gears and head over to Asia, because overnight, the story was completely different. The whole region saw this dramatic split, and it perfectly illustrates what we call a K-shaped recovery, where different parts of the economy rocket up while others fall down. On one hand, you have South Korea. Wow, the KSPI index just rocketed up over 2.3% to an all-time high, all driven by this full-blown AI supercycle. SK Hynix surged over 6%, and institutional buying was so insane, we're talking over 2 trillion won, that it actually triggered a buy-side circuit breaker temporarily halting trading. And then you have Hong Kong. The Hang Seng Index fell 1.1%, dragged down after some of its biggest tech companies like Tencent and Alibaba got hit by being included on a U.S. notorious markets list. Just 2 completely different worlds.
So with all this new momentum, this split, what's the big question? Where are we heading next? For that, let's turn to our quantitative models for a data-driven look at what March could hold. This dashboard gives us a quick snapshot of market health, and you can see the story right away. The key momentum indicators for the Nasdaq, the S&P 500, and especially the Kospi are all flashing green, signaling very strong upward trends. In fact, the Kospi is so hot, it's actually tipping into overbought territory. But then you look at Hong Kong, and its indicators are just weak, confirming that split path we just talked about. So based on this momentum, our optimistic scenario, which our model gives a 70% probability, is projecting some pretty significant upside targets for March. We're potentially looking at a nearly 6% gain for the Nasdaq 100, targeting 26,500, and another almost 6% gain for the Kospi. This is all being driven by the expectation that this AI capital spending spree continues, and we get more positive policy news. Of course, it's always critical to look at all the possibilities. While the optimistic case is the most likely, there is a 15% chance of a pessimistic scenario, where maybe a geopolitical flare-up triggers an inflation spike and a 5 to 10% correction. And there's an equal 15% chance that the market just goes sideways for a bit to digest these huge gains. Okay, so how would a professional quantitative analyst actually try to navigate this environment? Let's take a look at an example model portfolio. It's designed to capture this upside while being really, really smart about managing risk. This is what we call the Relief Alpha model. It allocates 65% of the portfolio to positions that are designed to capture the rally's momentum. But, and this is crucial, it dedicates a full 20% to specific hedges against the key risks and another 15% to a strategy that's focused purely on market volatility. So here's how that actually breaks down. The buy portion is all about leaning into the rally's leaders, semiconductors, using indexes like the SOX and the Kospi, and even French luxury goods. The hedge side is about protecting yourself. It holds an energy ETF to guard against geopolitical shocks, and it shorts U.S. real estate, which is still very sensitive to interest rates. Finally, that volatility piece involves selling VIX puts, which is basically a strategy that profits if market fear continues to calm down. Now, this next part is maybe the most important. And let me be perfectly clear, this is not financial advice, but it's a critical example of professional discipline. A strategy like this has to have strict, non-negotiable rules. For instance, a maximum portfolio drawdown limit of 4.5%, and a clear, unmistakable exit signal. If an indicator like the Chaikin money flow, which tracks big money, turns negative for 3 straight days, the model gets out of everything. Safety first, always. Which brings us to our final thought for today. The big legal and regulatory roadblocks that were holding the market back have just been removed. The path, for now, seems clear. So the question we'll leave you with is this. With all the external roadblocks gone, is the market's biggest risk now its own unchecked optimism? Something to think about. Thanks for joining us.